And then the last point, the last reason that I wrote the book was I wanted to make people aware of how important efficiency is. Efficiency in all aspects of your finances, but especially efficiency in retirement planning. If any of you read my article in Lancaster County Magazine this month, I was focusing, or I think the title of the article was something about cutting your taxes in half when you retire. And that's not just a pipe dream. If you do this properly, if you build the three-legged stool properly, you can control how much tax that you pay, because what you want to have out of these three legs is one leg that has all after-tax money, one leg that has all pre-tax money, your 401k, and one leg that has your tax-free money, which is your Roth. And so now as you're constructing your income streams, you take money from each one of these in a way that minimizes the amount of taxes that you're paying. So if we have to take a little bit more from the tax-free leg, a little bit less from the taxable leg, we do that in order to keep ourselves in a lower tax bracket. And when you're retired, this is even more critical because it affects how much of your Social Security would be subject to tax if you don't do this right. So you want to be able to control that. But so many people, I've often been asked, what's the biggest mistake in retirement planning? Well, the biggest mistake is not saving enough money. So that's number one. Second biggest mistake is saving it incorrectly. Just like Jonas Byler, you end up retired, you've done all this defer, and now every time that you want to spend a buck, you got to pay tax on it. And so do we really have $1 million in a 401k? Or do we have something like $700,000, because that's about what it's worth after you take it out in tax? Wouldn't you rather have $1 million for retirement with a third of it being already taxed, a third of it that's tax-free, and a third of it that has yet to be taxed, and be able to control that? My example is Shirley Bachman for this point in the book. And Shirley was in her mid-70s. She was a widow. She was already taking her minimum distributions, and her plan was not really that bad. She had about half of her assets were in after-tax, half of her assets were in pre-tax, so it was in an IRA, and she was taking minimum distributions. And the person that was helping her with her investments didn't do a really bad job either, because part of it was about half of it in bonds and half of it was in stocks and stock funds. So not a bad allocation, 50-50. She had plenty of money to live on, to create this income stream, but yet she was frustrated because she was paying quarterly taxes, and she wanted to be able to get the taxes down. And the reason she had come to us is because she ended up paying a lot of capital gains, and she had no idea that she had capital gains. Shame on her advisor. He should have advised him of that so that she could prepare for it, but that made her angry. So here she is, and we're retiring. And I just love these cases because I look at this and I think there are so many things we can do to make your situation so much better from a tax standpoint. I can't even wait to get started. So we took all the bonds that were in her taxable account and moved them to the IRA. I know you're saying you can't do that, and technically you can't do that, but you can sell them in one and buy them in the other. I'm not going to go into details on how you do that. But anyway, the bonds got moved into the retirement account and the stocks got moved. That cut down on her taxable interest income significantly. And the other thing about being efficient is, remember I said about paying your taxes efficiently? When you're 70 and a half and taking IRA distributions, you shouldn't be paying quarterly estimates. You can pay that all out of your IRA because you have to take it out of your IRA anyway. Why not take it out in December and pay all your taxes at one time? I was telling a guy this one time and he says, that's illegal. You can't do that. No, it's not illegal, and you're not going to get penalized for it, because when it comes on your 1099-R, it's going to show that it was withheld, and the IRS deems that that's okay. But you've had the opportunity to earn money on your taxes all year long and pay them in December when we've done the last tax projection and we know pretty much what your tax bill is going to be. So we eliminated her paying quarterly estimates. We got the tax bill down to where it could all be covered out of her required minimum distributions, and hopefully she was happy. She wasn't real happy about 2008, but she was happy with what we had done at that particular point. So efficiency. Efficiency not only saves you money, but it can raise your return. Imagine what your number could be if it's all in a pre-tax account or if it's in proper three-legged stool. So just in conclusion, my final point And what I would like everybody to take from reading the book is the importance of planning. Having a plan and then having a strategy to implement or to pursue that plan. Like driving a car across the country. We know where we want to go, that's our plan, and now we've developed a strategy for how we're going to get there. How we're going to get there efficiently. We're going to make sure that the car is well maintained. We're going to make sure that our tires are properly inflated. We're going to make sure that we choose a car that gets good gas mileage. We're going to lay out a route that maybe it's not the most direct route, but it's going to take in some things that we want to see along the way so that we can enjoy the ride. And the importance of this is really drawn out in 2008, because the people that had no plan, that had no strategy, when the market tanked in September and October and November, were lost. And just like my example of driving the car, they got to the Mississippi River, the bridge was out, and they turned around and went back. Or they got out of the car and walked home. They just gave up. The market went down, they had no plan, and they sold their stocks. It's not a successful strategy. We do not buy high and sell low. That leads to disaster. But if you had no plan, you were lost. You had nowhere to go.